mean, I was just listening to the panel next door about is the UK market cheap? I don't know whether any of you saw that. But I think it is cheap. I think there are lots of very undervalued stocks out there. And I brought with me some stats which I think really highlight where we are compared to where America is. And if you look back over the past 10 years, the S&P 500 has tripled. That's without dividends. You look back over the past 10 years with the FTSE, it's up 20%. The past year, the S&P is up 30%. We're down 3%. As you probably all know, AIM has fared a lot worse. And even when you add in dividends, I was thinking to myself, oh, I bet when you add in dividends, we're doing much better. No, we aren't. With dividends, the S&P 500 is shooting out the lights. And we're doing all right, but we're just not doing anywhere near as well as the States. And why is that? Is that because our companies are worse? Well, I don't feel as if it is. I feel as if it's because lots of other things, regulation, trends, general sentiment, is really against us. So I feel as if, and it's not just me, is it?
No.
There are lots and lots of takeovers. As Gervais Williams next door said only a moment ago, pretty much every single day,
yes,
you're getting another takeover.
Totally.
So we're cheap.
Yep, I would totally agree with that. Jonathan, what would you think?
About the UK or about the market?
Yes. Well, you tell us, Jonathan Davis.
Oh, you, this one. Sorry, you go, yeah.
You tell us what you think, Jonathan.
I sort of dog whistle when I hear my name.
It's so confusing.
I start talking, you know.
JD and JR.
You go.
You sure?
Yes.
Okay. Well, what do I think about the markets? I think I see them through the lens of investment trust. That's my specialist area, as many of you will know. And I think we're at a very interesting juncture in terms of where the potential is for investment trusts. But it has everything to do with interest rates, and I can talk about that a little bit more in a moment. But we had a very interesting turning point back in the autumn, I think, when for the first time, for 2 years, we actually saw a turning signs that the investment trust malaise of the last 2 years, which has been a very tough period for anybody investing in investment trusts, has actually turned. And when I write in my newsletter, Moneymakers, I actually think highlighted that in September. Things went down a bit more until the end of October. But I think that's going to continue this year. So you're going to get, if it does happen, you're going to get a kind of geared impact of whatever the markets do. I share your view that the UK market looks cheap and attractive. I have been very wary of actually putting more money into it myself because the liquidity problems are very acute, but I think they could be about to turn. And I can list later on some other investment trusts I think will do well, given that the market performs as we all hope and goes further from here.
Right, and Jonathan Roy.
So you have to echo in that definitely the UK markets are particularly cheap at this point in time, and they have been cheap for the last 3 or 4 years. So the question is now, at what point do they change? And is that point going to be soon? And I think, as Jonathan mentioned, that what's happening with interest rates at this point in time could prove to be the catalyst for that, especially at the small cap end of the market in London. There's been low volatility, low liquidity there in shares. We were not seeing the trades going through that we may have done before the pandemic. But I think as soon as we start to see monetary policy shift at this point, for those companies that do have attractive valuations, we're going to start seeing fresh funds coming into the market for that. And as Joanne said, just in the last 2 months, 3 months, how many companies have we seen in the UK being taken over? And this is US smart money coming in. It's their competitors within the industry. So they're obviously looking at these companies and thinking, okay, maybe they're cheap now. Maybe the next 2 years aren't going to be fantastic. But the people that are coming in for these companies are taking a 5 to 10 year view. And that's something that as we start to move through this process and we start to see interest rates being reduced, I think we then start to see that follow through into UK equities.
So you think we'll see more bids? A lot more bids?
I think we'll probably carry on at the same pace, because if you are a US private equity company and you're looking at these companies, if they stay at the same valuations and it fits your model or it fits your business, right. if you're looking at acquiring a competitor, if the valuations stay here, there's no reason why there won't be any more takeovers.
And those companies will be taken quickly off the market. They'll be groomed, and then within a couple of years, they'll be stripped out of the private equity companies and floated back onto the market in some form or another, which is the way PEs work. Isn't that right?
It could be, yes, I guess,
Yes,
unless they're trade buyers, in which case they'll just be subsumed within some great big American conglomerate. Yeah.
So, so tell me, Jonathan, which investment trusts are you looking at particularly? Which do you really like the feel of?
Okay, so...
is it management that you like the feel of, or just a particular trust?
That's a big question, yeah, a very big question. And I have perhaps a different stance from some people. I just wanted to show you one chart. That's all I'm going to show. And this is this one here, which you may say, what the hell does this show? This shows basically the performance of the investment trust sector overall, the investment trust index, which is all the investment trusts that are in the FTSE All-Share Index, which there are 190. And the other line, the bottom line, is the representative gilt yield ETF. So in other words, and we've seen, as we know, we've seen this dramatic movement in interest rates over the last 2 years. And investment trusts, basically, they have tracked that movement in bond yields very, very precisely, particularly in the alternative sector, which is about half the investment trust sector, but also in the equity trust sector. And so if you believe that gilts have bottomed out, which I think they have, yields have bottomed out, as it were, at that level, I'm not 100%. The charts don't tell us that that's actually bound to happen. A lot of people saying they hope it happens, but it hasn't actually happened yet. We haven't really had much of a signal from the markets about that. But if that's the case, you're going to see basically a general rise in investment trusts across the piece. And what I have done, I've got lots of lists here, but I'm not going to show them all, so don't bother. But if anybody wants to get in contact with me, I can send you these copies of these slides, and they look at investment trusts a number of different ways, including the ones that I identified as being good opportunities back in September. I think they're all still good opportunities, and I'm not sure. Yeah, here we are. So these are some of the ones that I mentioned back then, and you can see in the middle column there the kind of return they've had since for the 1st of September when I recommended them, and then at the end of October when the movement finally changed. And you can see they basically fall into, if I can very quickly put this in 3 categories basically. Number one, if you're investing in investment trusts, you really need to understand them, and you should therefore normally be a long-term investor. Okay, so what these market conditions create is the opportunity to buy really good, proven funds or investment trusts at a discount for the first time for several years. So that, I think, is your number one place to go. And I can mention lots of names in that context on my high-tech support system here. So, for example, things like, I think Scottish Mortgage is a buy again. I think that Fidelity European. I mean, I got a whole list here, about 15 names that I think I could recommend. These are proven long-term performers. And if you look in the Investment Trusts Handbook that I produce every year, if you just went to the 30-year best performers, it's a short table, it's about 25 names, and if you only invested in those, I think you would have a fantastic portfolio to ride this next phase of the market. And then there are some specific discount opportunities where the discounts appear to be very, very wide, 50%, 60%. You want to be very careful with those because they are discounts to net asset values. Most of them are in the alternative sector, and those net asset values, shouldn't be trusting them to be fair, representing what the value of the company is. So big caveat about alternative asset trusts. But if interest rates do come down, those alternatives, things like commercial property, private equity, and so on, some of these specialist renewable energy ones will do well. They will give you a very attractive yield, plus they will get some capital gains. And again, I can send anybody who's interested, I'll send them the names that I have in that category.
I have to say that Jonathan publishes a cracking book called the Investment Trust Handbook, and £25, Harriman House, yes?
That's right, yeah.
And it's got all the questions and all the answers, and it's a very well presented and well published book. I'm just asking you very quickly on that, which company, I mean, do you go geographically when you're assessing your investment trust favourites?
Definitely. I mean, I think the caveat to everything we said earlier about the UK is, the big question is how much of your portfolio should be in the UK.
Yes.
And that's a big question, and I don't think it should be a lot. I mean, basically, even though there's good value there,
You're not
it
a
may do
supporter.
better. But not, yeah, exactly. Not, you know, the last 25 years, the story's always been don't bet against the US, okay? And that's been the right thing to do. That's been the right strategy. Everybody's talking about how it's, you know, the market is ridiculously expensive, and I think it is. But you're still going to want to have more than half your portfolio, as far as equities are concerned, in other parts of the world than the UK. I mean, that is, I think, an important caveat to what we were saying earlier.
Very good.
For basic reasons, diversification and some of the opportunities you find in other countries. And we've heard about some of them today, like Vietnam or India or something, are good things to add at the margin to your basic global exposure.
Jonathan, Roy, tell me about your publication. Who do you appeal to with your basic publication?
So it's of course focused on UK investors. However, we do provide a global perspective, and coming into this and looking at potential tips going forward from here, we're of course talking about UK markets, but I think one of the areas that's being overlooked, not just by UK investors, but by global investors at the moment, is China. If you're looking at the valuations there, compared to the S&P 500, we haven't seen the dispersion in the price to earnings for about 15 years at this point. And we're seeing at this point in time, I feel, if not maximum, but pretty much maximum disillusionment with what's happening over there. Of course, we've got the property crisis. There's big unemployment among the young at the moment. They're looking at resetting their growth trajectory, looking at 5% going forward. Some people are saying that's maybe a little bit too ambitious for them. However, this is all building a huge wave of uncertainty around it. Sentiment is pretty much the lowest it's been in 30 years on China. And when you get this scenario, this is when you can start to see big moves. I mean, if you're looking at the Hang Seng index, it's trading at about 9 times earnings. And if you compare that to the S&P 500 that's trading at 23 times earning at the moment, it doesn't take a lot in terms of the sentiment moving for people to start looking at China again. They're looking at easing foreign investment in there. They're looking at the manufacturing sector at the moment. And this is, I feel, the start of things to come. You know, this is something, they're looking at the world and they want people to be investing there, so they're going to make it easier for them. You know, they've gone through a difficult few years with COVID. The government there know that they have a lot more at their disposal to get the economy going. You know, just in the last couple of weeks, there's been some anticipation around stimulus that didn't really come in. We saw some disappointment, particularly in FTSE 100 miners this week. But I think, you know, they're testing the water. They're seeing what markets like. They're seeing what their equity markets react to. And when they work out which way they want to go, they're going to be able to make some big moves. And going back to the investment trusts that Jonathan mentioned, if you look at some of the trusts out there that are focused on China, you're looking at 20% discounts, 10% discounts. And if you're bearing in mind the shares are trading at about 9.5 times on the Hang Seng historical PE ratios, if you're able to secure a trust at a 10%, 20% discount, you're actually looking at buying that index at about 8 times earnings, which is pretty compelling for the world's second largest economy.
Do you think the Chinese government is doing much support of Chinese equities?
I think it's trial and error with what they're doing. You know, they've looked at stimulating the economy. You know, if we go back 5 years, anything they did to stimulate the economy, whether that was cutting reserve ratios, providing liquidity for the banks, we always had a big reaction in markets, but we don't tend to see that. We've of course seen targeted action on the equity markets, but I think from their perspective, they can do that if they really feel that they need to, but in the context of what Western economies would do. I don't think they want to be seen to be directly intervening in their equity markets, because that may turn off foreign investors coming into it. So there's a lot more that they can do with the economy. They, of course, have got their problems, but from a valuation standpoint, it's particularly compelling.
Especially with the property sector then over there, that's been knackered.
Yes, I mean, and that's one of the reasons you see that index down at those levels, and they've got some of the biggest technology companies in the world within that index. Yes, there's problems in the property market, but whether we're past the worst, that remains to be seen. But I think it's going to be difficult for it to get much worse because they can step in and they can prop it up. I think they want to let it play out, see what happens there, and then once that dies down and they open up the economy a little bit more, if they start letting people in, a little bit more investment coming in, then that starts to make it particularly
What do you
interesting.
think about China replacing old cars with new EVs for their population?
Well, you're looking at a Chinese company now, which is the world's biggest manufacturer of electric vehicles. So, there's talk about oversupply there. I think that's just them showing that they can lead the world in terms of technology. It demonstrates what they want to do as a country. Of course, there's political rifts with the United States, and there's questions about what's going to happen in Taiwan. But I think, if markets were pricing any military action in Taiwan, you'll see the Chinese equity markets are a lot lower than where they are. I don't think that's priced in at the moment. I think if anything happens there, you're going to see significant fallout. It's a risk, but I think it's probably priced in for this point in time. They're doing huge amounts to support their own technology industry. They're looking at innovations that are rivaling the United States at the moment. So that sort of battle, it's going to be difficult to see how that plays out. But if they're able to maintain that industry within themselves and grow from a domestic point of view, I think that's going to be.
Well, they're really pumping them into the UK, aren't they?
Yes.
Anyway, what do you think, Joanne? And do you like risk-intolerant positions or risk-tolerant positions?
I think it's really important to have a blend.
Yeah, this is true.
A kind of, I don't know whether that's the answer that you were expecting or wanting, but diversification it's a trite phrase or a trite word, but it's absolutely essential for good returns. You have to have a blend of the solid dividend yielding stocks, and then I think it's always nice to have a few sort of sexier,
of course,
possibly they're going to do well and possibly they're not type stocks.
Sunday mornings, reading Joanne's Midas column in the Mail on Sunday. She writes so often about the companies I'm about to write on, so I'm thinking, oh, bugger. But it's brilliant stuff and enjoy it. Now tell me, have you got any favourites, any previous favourites? No, I don't want to know what's in tomorrow's paper. So, any favourites currently?
I think I have quite a few favourites, and some of them I like because they've done really well, and some of them I like because they haven't done well, but I think they should.
Yep.
And sometimes you just find, I would say, for instance, Bloomsbury.
Oh, beautiful.
It's a great stock. It's really well run because I think, even pre-COVID, people just thought, well, nobody's reading, everybody's going to start doing something else, they're all on their computers, blah, blah. And they've managed to, first of all, I think COVID showed that people still do want to read, and they seem to have continued to want to read. And also, I think really cleverly, they've pivoted into academic publishing and online publishing.
Very good.
So they've kind of
Perfect timing.
Yeah, they've done what Pearson is doing, but they actually did it first.
Yes, they did.
And
a whole range of subjects.
Yeah.
Oh.
And then they've got the Harry Potter franchise, which whatever anybody thinks about J.K. Rowling, and a lot of people think a lot about J.K. Rowling, but the people buying those books are still buying the books.
And they will be.
So,
and Sarah Maas.
Yes,
Oh,
yes. And
God.
yeah, all those kind of
And
fancy.
it's a money machine in itself, isn't it?
It is.
And very well run.
Very
well run. And anything else?
Well, I quite like Literacy Capital. It's another bookish one. But
Which one, sorry?
It's called Literacy Capital.
Okay.
And it's an investment firm where 1% of the I think it's post-tax profits, are put into reading charities. And that's because the wife of the founder her mother couldn't read when she was a child.
Lovely.
And so she grew up knowing how much her mother was losing out.
Brilliant.
So she's putting money into, so they're putting money into, but apart from that sort of charitable thing, it's a really, really well-run business, and it's one of the few in that kind of investment space that's actually done well in the past 5 years. So
Yeah, very good.
That's an interesting
and what's their market cap? Do you know how big they are?
I'm afraid I don't know how big
Okay, no worry,
the market
no
cap
worry.
precisely, but it's a reasonable size.
We'll look for it next time we write about it.
Yeah.
Jonathan, do you... Pardon?
I own that one as well. It's a very, very well run
It's a really
business.
Oh, right, very good.
Yeah, it's
Father and son outfit.
It's a father and son and the father, Paul Pinder, has a very strong track record as managing a well-known UK-listed company for 25 years. He's a very smart gentleman. So yeah, very good. Trading on quite a narrow discount there. It's on about a 3% discount at the moment. It's about 300 million, I think, something like that market cap, something like that.
Very good.
But done extraordinarily well over the last couple of years. Yeah, so I like that one too.
Very good.
really good.
Any specific stock you want to mention?
Yeah, I mean, in terms of the UK markets, we quite like Ocado at the moment, and it's one. You know, it's not for everybody. It trades more like Tesla than it does Sainsbury's, but it's a business that people look at and immediately think of the retail business. The reason why we like it is not for the retail side of things. That we feel was there to demonstrate that their CFC side of the business can work. You know, for them to go to major food retailers around the world and present a technology which they haven't proved before was something that was going to be quite difficult. So they've gone out and they've done the retail business, but the infrastructure that they're building in the distribution of food across the world is something that's unrivaled. It's probably not a story for the next year or two. It's probably a story for the next 5 to 10 years. But once they do that, and they have, I mean, they've got plans at the moment with Saudi Arabia. They've got plants come online, I think, this year in Tokyo and Melbourne. And these are partnerships with the world's biggest grocers. You know, to get those relationships and to build that infrastructure is something that it takes a long time to do, but once it's there, that's something that's going to be providing revenue for Ocado long into the future from here. So Ocado is one that we like.
And their problems with an M&S, what do you reckon?
Yeah, so I mean, you're obviously looking at the margin side, and I think they're calling back to 171 million or something at the moment that they say that they're owed. I think that for us, that's a distraction. You know, people look at Ocado, and it is at the moment that the lion's share of their revenue. It's not a hugely profitable area of the business. It's difficult to see how that becomes particularly profitable going forwards, but I think it's there for them to build up their know-how within the industry. They can use their experiences in rolling this out to other businesses around the world.
Very good. Right, very quickly, across the panel. Jonathan, where do you think the FTSE 100 will be within a year? By the end of this year, go on.
Absolutely no idea.
Okay, next one, Jonathan.
The end of this year.
Or what will it have touched?
I think we're going to see a low. We're going to see a fallout at some point this year. Central banks need to move, but I don't think they're going to move until the markets tell them to move. If anything, if history's anything to go by. So I think we could probably go down and touch 6,000 at some point, but I think we...
bloody hell, go out now. Sell.
I think that we'll probably finish the year, you know, 7.2, 7.3.
Oh, you're a pessimist.
I'm more optimistic, not least because we're going to have an election this year.
Yes.
And
In May or October?
that
November.
I can't tell.
Okay, right.
But
No.
I go more for October than May.
Okay,
But I think whenever it is, I think that'll give some sort of bounce. And I think the FTSE will definitely end the year higher than it is now.
Yes, very good. Yeah, I'd go for 8,000.
Yeah, I'm thinking the same.
Hey, I'm an optimist, you know, that's what I write. I find it hard to go on the bear tack on stocks. You know, you've got companies that are well run, and they have their hassles, they have their abilities and their creative content, and some of them get absolutely awful market pricing. And I can never go on the bear tack, apart from some of the company bosses I've met, and I would think, never in a month of Sundays are you going to have any of my money. And there are a few of those. They never make mistakes, but in fact they always make mistakes.
Can I mention a couple of quick names, the UK names? Would you like to hear?
Yeah, go on.
I only own 2 individual stocks in the UK market. So, a concentrated portfolio, you could say. But it's a company called Restore. Have you come across Restore?
Lovely.
Ticker
Yep.
RST. Very interesting situation there. This is a document storage company which generates huge amounts of cash. The guy who used to run it retired about 3 years ago. His successors made a complete horlicks of it. Went from having gone from 25p to £5 and back to £3, or back, no, £2, I should say. He's just gone back to run it again. Not always a great recipe for things, but I think that's an interesting situation.
Next one.
And the other one is a company which I bought several times and sold several times, which is it called Judges Scientific? Is it called? Mm-hmm. Which is a very interesting company and keeps coming
Judges
back.
Scientific.
Oh, yes, right. Gosh, yes.
The only thing I have bought a lot of things recently, so I've been sort of put my money where my mouth is. I bought a lot of Pershing Square Holdings, which is an interesting trust, not a UK company, obviously. Fidelity European, another very solid trust, which is trading on a 10% discount. That's a really good, safe bet. And then some of these alternatives, I was quite rude about the alternatives earlier on, but some of the renewables, which you heard about earlier from the quoted data people I know, but things like UK Wind and Bluefield Solar, they're offering yields of 7 to 8%. And if the market does move, if bond yields do move, they will deliver you capital return as well. They're very well covered as dividends.
I'm mentioning UK Wind in my column tomorrow. Actually, UK Greencoat UK Wind, or are you talking about?
Greencoat UK Wind, yeah.
Yes.
I call it UKW as the ticker, but yeah. So anyway, so there's been some good things out there.
Right. I've got 2 stocks. I don't own shares. Okay, I don't hold any shares whatsoever. But I would be buying Billington Holdings, the structural steel company, superbly run, fabulous business, good balance sheet, figures coming out shortly. So easy peasy, that one. I'd also go back on a company I've mentioned many times before, SRT Marine Systems. They have recently raised a whole chunk of money from a new company coming into their equity, buying at 8-9% Ocean Infinity. And it's a well-run business. It's got masses and masses of potential. They're breaking into profitability. They've just stretched their year to 15 months so that they can actually cope with some contracts and contract difficulties, and technicalities in the Far East. But it's a lovely business. I think it's so important. The shares are literally on their backside. They raised money at 35p when Ocean Infinity came in. They went up to 42, come back, I think they touched 29 this week. They're currently about 31. I think those shares are 50, 60, 70p because it's the right business. It's maritime awareness. And you just think what's going on with the Houthi rebels in the Red Sea. And just to know the conflict that is going on inside the international waters. And SRT literally is covering that marketplace. And they're doing very, very well out in the Far East. So SRT and Billington, both interesting looking companies.